All right, let's dive into the Indian market outlook today. Looks like we've got two sources you've sent us. One's kind of like a quick take on the market sentiment, pretty positive, right? And the other's a much deeper dive, a whole newsletter, packed with data. So our mission today is to kind of synthesize those two, see what they tell us about the market, what it all means, especially for you, for your investments.
Yeah, I like those, like, like the bird's eye view, and then also the street level map. When we put those together, I think we get a really interesting picture of what's going on.
Yeah, absolutely. So let's start with that bird's eye view, that first article. Market's positive turn. I mean, it's bullish, right? They're saying stay invested, be selective, sector selective.
And that's where I think this newsletter is really helpful.
Yeah.
Because it actually dives into some of those sectors. So banking, finance, IT, and pharma, those are some of the ones they highlight as, really having strength right now.
Okay, so this newsletter is definitely numbers heavy, right? We've got PE ratios, PB ratios, nifty levels. A lot of our listeners might not immediately know what all of those are. So can we just break some of those down just so they're not totally lost in the data?
Yeah, absolutely. I mean, so let's start with those ratios. Price to earnings, the PE ratio, basically it's like a price tag. On a company's earnings, it tells us how much investors are willing to pay. For every dollar of profit, a high PE often suggests there's high growth potential. But it could also, there's more risk involved. Price book PD ratio, that compares the company's market value to its book value, which is kind of like its net worth. So this can give us an idea of whether a company might be overvalued or undervalued.
So are you saying, like, if a company has a really high PE ratio, it's almost like investing in like a hot new startup. It could have a lot of potential, but it also
had a lot of risk of, not really taking off. Yeah, that's a great way to put it. I think that's a great analogy. And then we've got the Nifty 50, which is India's benchmark stock market index. It's kind of like the Dow Jones in the U.S. And the newsletter shows that right now it's actually trending upwards, which reflects that overall positive sentiment that we've been talking about.
Yeah, that's a good sign. And then I also see that the newsletter mentions India VIX. Can you explain what that is and why our listeners should care?
Yeah, so the India VIX, it's basically a measure of market volatility. It's kind of like a fear gauge. When the VIX is high, it means investors are feeling more uncertain about the market. Now, the newsletter highlights that. The India VIX has actually been dropping recently, which means the market is becoming less volatile.
Oh, okay. So less fear, more stability. I mean, that sounds pretty good. Does that factor it all into that 6.2% projected annual return that the newsletter mentions?
Yeah, I think that plays a role. That 6.2% figure comes from both the original and modified Buffett indicator models. And there's really a combination of a few things. Economic growth, dividend yields, valuation reverse.
Yeah. And I think 6.2% might not sound like a huge number, but it's important to remember that just a projection for the overall market. Within that, there could be certain sectors that are poised for much higher growth. But I think the question for you, the listeners, is what does that 6.2% mean to you? Is that in line with your expectations? Is it higher than other investments you're considering? Lower? That's the key question.
Yeah, and I think it's also important to remember that no projection is a guarantee. The market changes all the time. So it's really important to stay informed.
And adapt your strategy.
Absolutely. Speaking of adapting, the newsletter gets
pretty specific
with us. Buy-sell recommendations based on those MTY levels. So, for example, if the Nifty drops below 23,000, they're suggesting converting debt to equity. Yeah, and I think here it's important to really emphasize that these are just suggestions, right? These aren't blanket recommendations. Converting debt to equity or vice versa. It's a complex strategy. Yeah. It has its own risks. It has its own rewards. It really depends on your financial situation, your risk tolerance.
Totally. Like they're giving you the ingredients, but you have to decide what to cook.
That's a great way to put it.
Yeah.
And before you start cooking, it's helpful to understand how the kitchen works.
Yeah.
The newsletter actually provides kind of a timeline of market sentiment shifts over the past few years. It's actually fascinating to see how sentiment ebbs and flows, how different factors really influence those changes.
Yeah, like looking back at the history book of the market and seeing how things have played out in the past can help us think about the future, right? And speaking of things to look at, I noticed that the newsletter also gives this really detailed breakdown of sector performance.
Yes, and I'm interested in, those outliers, the ones that are either doing exceptionally well or maybe lagging behind a little bit.
Right, because they can tell us a lot about what's going on more broadly in the Indian economy. So let's dive into that next.
I think those outliers are often like the most interesting stories. They kind of give us clues about emerging trends, maybe some hidden opportunities, potential risks.
Exactly. So let's talk about those specific sectors that the newsletter highlights. We've got banking, finance, IT, and pharma. So why are those doing so well, and what does that success tell us about the broader Indian economy?
Well, I think each sector has kind of its own unique drivers, but there are some common threads. All 4 of those sectors are heavily influenced by global trends, and particularly India's growing role in the global economy.
That makes sense. I mean, India is becoming more and more a real powerhouse on the world stage.
Exactly. So if you look at banking and finance, for example, they're benefiting from increased investment flowing into India, as well as the government's focus on financial inclusion, which is bringing millions of people into the formal banking system.
So it's kind of like internal policies and external factors all kind of coming together.
Right, exactly. And then IT, that's a story that I think a lot of people are familiar with. India has a vast pool of talented IT professionals making, a global leader in software development and IT services. And the demand for those services is only increasing worldwide, which bodes well for the Indian IT sector's continued growth.
Yeah, it's really amazing to see how India's really become such a dominant force in the global tech industry. And what about pharma? Curious to hear about that one.
Yeah, so the pharmaceutical industry in India is kind of two-sided coin. On the one hand, you have, a major global supplier of generic drugs, which are basically more affordable versions of brand name medications. And this has made India a critical player in providing access to essential medicines worldwide.
Yeah, so that sounds like a pretty stable and profitable part of the industry.
It is. But on the other hand, there's a growing focus on research and development of new drugs. India is striving to move beyond generics and become a leader in pharmaceutical innovation, which is a riskier, more long-term play, but that has the potential to transform the industry and position India at the forefront of medical advancements.
So it's like they're playing a short game and a long game. And listener, if any of these sectors have really piqued your interest, I mean, remember, this is just the starting point. You'll want to do your own research on specific companies within those sectors, look at their financials really carefully, and assess their individual growth potential.
Absolutely.
Right.
Don't just invest in a sector, invest in the company that you believe in. And remember, due diligence is key. Look beyond the hype. Really understand the company's fundamentals, its management team, and its competitive landscape.
Right. It's not just about following the trends. It's about making really informed decisions based on solid research. And speaking of research, the newsletter also kind of dives into different investment approaches, like that converting debt to equity under certain market conditions.
Yeah, and this is where things get a little more complex. Converting debt to equity is a strategy that can be beneficial in certain situations, particularly when interest rates are high or a company is struggling financially. However, it's not a decision to be taken lightly.
Yeah, I can imagine. It involves a higher level of risk. It's not for the faint of heart.
Exactly. It requires careful consideration, a thorough understanding of, the potential implications. Remember, every investment strategy has its own set of risks and rewards. There's no one-size-fits-all approach. The key is to align your investment strategy with your own financial goals, your risk tolerance, and your time horizon.
So it sounds like understanding those personal factors is just as crucial as understanding the market itself.
Absolutely. Self-awareness is key to successful investing. You need to know what you're comfortable with, what level of risk you can tolerate, and what you're ultimately hoping to achieve with your investments.
Right. I mean, this deep dive is not about telling you what to do. It's about empowering you to make informed decisions that are right for you.
Exactly. We're giving you the tools and the knowledge to navigate the market with confidence and make choices that align with your financial goals.
Now, we've talked a lot about kind of the positive aspects of the Indian market, but I'm also curious about potential challenges and risks. Every market has downsides, right? What are some things that listeners should maybe be wary of when they're considering the Indian market?
That's a great question, and you're absolutely right. No market is without its risks. One thing to be aware of in India is the regulatory environment. It can be complex. And subject to change, which can create uncertainty for businesses and investors. So stay informed about any regulatory shifts that could impact your investments. It's crucial.
Right. And I imagine that geopolitical risks are a factor too, as they are with any emerging market.
Absolutely. Global events, political instability, regional tensions, all of those things can have an impact on market sentiment and performance.
Yeah.
So being aware of those broader geopolitical factors and how they might influence the Indian market is essential for making
informed investment decisions.
So it's like staying up to date on current events and geopolitical developments is just as important as following the financial news.
Exactly. The world is interconnected. And what happens in one part of the world can really ripple through the global economy, including the Indian market.
So it's not just about understanding the numbers. It's about understanding the broader context in which those numbers exist.
Precisely. It's about connecting the dots, seeing the bigger picture, and making informed decisions based on a comprehensive understanding of the market and the forces that shape it.
Yeah. We've covered a lot of ground in this deep dive, but I feel like we've only just scratched the surface. I think that's the beauty of the market. There's always more to learn, more to explore, more to discover. And the more you learn, the more equipped you'll be to navigate the complexities of the market and make sound investment decisions.
Listener, as we wrap up this part of our Indian market deep dive, remember that knowledge is power. The more you understand about the market, the more confident you'll become as an investor. But remember, it's not just about knowledge, it's about applying that knowledge wisely. Take the time to do your research, consider your personal circumstances, and make decisions that align with your financial goals. And most importantly, never stop learning. Okay, so we've really explored this Indian market from like that big picture down to the nitty-gritty details. I feel like I'm getting a much better grasp of things.
Yeah.
But before we wrap up, I want to circle back to some of those metrics we talked about, especially PE ratios and dividend yields. I feel like there's even more to unpack there.
Yeah, I agree. I mean, these metrics can be like windows into a company's soul almost. They reveal their priorities, their growth strategies, potential risks.
So give us an example. Like say we're looking at two companies in the same sector. One has like a sky-high PE ratio. The other one's a bit more modest. What might that tell us?
It's like me. Comparing a daring young entrepreneur to a seasoned veteran, that company with a high PE, it might be attracting investors who are betting on its disruptive potential. Even if its current earnings are low, they're buying into the dream, the vision, but is also a riskier bet. That potential might not materialize.
Right. So a high PE could be good or bad, depending on how much risk you're willing to take.
Exactly. Now, that company with the more modest PE might be generating steady profits, returning value to shareholders through dividends. It's a more conservative play.
So it's not just about chasing the highest numbers. It's about understanding what those numbers mean.
Exactly.
And what about those dividend yields? How can we interpret those?
Yeah, so imagine two companies, both with solid earnings. The one offering a high dividend yield might be signaling that it has limited opportunities for reinvestment and growth. It's like saying, hey, we've got cash to spare. Let's share it with our investors.
But that could also mean they're not as confident in their future, right?
It's certainly a possibility. On the other hand, a company with a low dividend yield might be plowing its profits back into research and development, acquisitions, expanding into new markets. They're focused on building for the future, even if it means delaying gratification for investors in the short term.
So low dividend yield, not always a bad thing.
Right.
It could mean they're
ambitious.
It's all about context.
Yeah. And that's why it's so important to look beyond the numbers themselves and try to understand the story they're telling. What is the company's management team saying? What are their competitors doing? What are the industry trends? All of these things can help you make more informed decisions.
It's like being a detective. Almost. You have to gather the clues and draw your own conclusion.
Yeah, and like any good detective, you need to be adaptable, observant, willing to adjust your hypotheses. As new information emerges, the market is constantly changing, and the best investors are lifelong learners.
So true. As we wrap up this deep dive, what are some other avenues of research our listeners might want to consider?
Oh, the possibilities are endless. You might dive into the financials of specific companies. That really intrigue you. Explore the regulatory landscape in India. See how it might impact different sectors. Consider the geopolitical risks and opportunities that could shape the market's future. The more you dig, the more confident you'll become in making those investment decisions.
So go deeper, stay curious. Happy investing, everyone. We'll see you on the next deep dive.